Hello everyone and welcome back to my channel. In this video, I'm going to talk about how foreign institutional investors pump money in the Indian market and what are some of the smart money concepts that you need to know. If you are interested in learning more about investing, finance and economics, make sure to hit that like button and subscribe to my channel for more videos like this. Foreign institutional investors, or FIIs, are entities that are based outside of India but invest in the Indian securities market. They include hedge funds, mutual funds, pension funds, insurance companies and investment banks. FIIs play a very important role in the Indian economy as they bring in foreign capital, expertise and technology. They also increase the liquidity and efficiency of the market and provide diversification opportunities for domestic investors. FIIs have been investing in India since 1992, when the government liberalized the economy and opened up the market to foreign investors. Since then, FIIs have been largely positive about India's growth potential and have invested billions of dollars in various sectors such as IT, banking, telecom, infrastructure, consumer goods and so on. According to the India Brand Equity Foundation (IBEF), FIIs invested 80,309 crore rupees (10.15 billion United States dollars) in the primary markets in 2021 and 6,371 crore rupees (859 million United States dollars) in 2022 until July. The net inflows for FII investors in India were 50,089 crore rupees (7.06 billion United States dollars) in the calendar year 2021. So what are some of the factors that attract FIIs to invest in India? Well, there are many reasons why India is considered one of the fastest emerging economies in the world and a leading country in attracting foreign investments. Some of them are: India has a large and young population of over 1.3 billion people, which provides a huge domestic market and a pool of skilled and talented workforce. India has a stable and democratic political system, which ensures policy continuity and reforms. India has a strong and resilient macroeconomic framework, which has enabled it to withstand external shocks and maintain a high growth rate. India has a diversified and dynamic industrial base, which offers a range of opportunities for investment across sectors. India has a vibrant and innovative startup ecosystem, which has produced many unicorns and global leaders in fields such as e-commerce, fintech, edtech, healthtech and so on. India has a favorable regulatory environment, which has eased the norms for foreign investment and simplified the procedures for doing business. India has a strategic location and strong ties with major global partners, which enhance its trade and investment prospects. All these factors have made India an attractive destination for FIIs who are looking for long-term returns and growth potential. However, investing in India also comes with some challenges and risks that FIIs need to be aware of. Some of them are: India has a complex and diverse socio-cultural landscape, which requires a deep understanding of the local context and preferences. India has a high fiscal deficit and public debt, which limit its fiscal space and increase its vulnerability to external shocks. India has a persistent inflation problem, which erodes the purchasing power of consumers and affects the profitability of businesses. India has a weak infrastructure and logistics network, which hamper its productivity and competitiveness. India has a low level of financial inclusion and literacy, which restrict its access to formal credit and savings instruments. India has a high level of corruption and bureaucracy, which create hurdles and delays in decision-making and implementation. These challenges and risks pose some difficulties for FIIs who want to invest in India. Therefore, FIIs need to adopt some smart money concepts that can help them navigate the Indian market successfully. Some of these concepts are: diversification. FIIs should diversify their portfolio across sectors, regions, companies and instruments to reduce their exposure to specific risks and enhance their returns. Due diligence. FIIs should conduct thorough research and analysis of the market conditions, industry trends, company performance and governance before making any investment decision. Hedging. FIIs should hedge their currency risk by using derivatives or other instruments to protect their returns from exchange rate fluctuations. Monitoring. FIIs should monitor their investments regularly by tracking the market movements, company announcements, and regulatory changes that may affect their returns or exit options. Engagement. FIIs should engage with their investee companies by participating in board meetings and shareholder meetings, and providing feedback and guidance on strategic issues. By following these smart money concepts, FIIs can improve their chances of success and profitability in the Indian market. Now that we have covered some of the basics of FIIs and smart money concepts, let's look at some of the examples of how FIIs pump money in the Indian market and what are the impacts of their actions. Here are some of the recent cases of FII investments in India. In November 2021, FIIs invested a net sum of 30,385 crore rupees $4.06 billion United States dollars in equities during November 1 to 18 squared. This was driven by positive global cues, strong corporate earnings, festive demand and easing of COVID-19 restrictions. The FII inflows helped the Indian stock market reach new highs, with the Sensex crossing the 60,000 mark for the first time on November 3. In October 2021, Reliance Industries announced that it would acquire German retailer Metro AG's cash and carry business in India in a deal estimated at around 500 million euros $560 million United States dollars squared. This was seen as a strategic move by Reliance to expand its retail footprint and leverage its digital platforms. The deal also attracted FII interest as Reliance is one of the largest and most valued companies in India. In July 2021, JM Financial Pay led a 95 crore rupees $12.7 million United States dollars investment in SilverEdge Technologies, a cloud-based software company that provides solutions for the insurance industry squared. This was part of JM Financial PE's strategy to invest in niche and emerging sectors that have high growth potential and scalability. The investment also reflected the growing FII interest in India's tech sector, which has witnessed several IPOs and acquisitions in recent times. These are just some of the examples of how FIIs pump money in the Indian market and create value for themselves and the economy. However, FIIs are not always bullish on India and sometimes they also withdraw their money from the market due to various reasons such as global uncertainties, domestic issues, policy changes or profit booking. For instance, in March 2020, FIIs pulled out a record Rs. 1.1 lakh crore $14.7 billion United States dollars from the Indian market due to the COVID-19 pandemic and its impact on the global economy cubed. This led to a sharp fall in the Indian stock market, with the Sensex plunging by over 30% in a month. Therefore, FIIs are not always reliable or stable sources of capital for the Indian market and they can also cause volatility and instability in the market. Hence, it is important for domestic investors to be aware of the FII activities and sentiments and not blindly follow them or depend on them. Domestic investors should also develop their own smart money concepts and strategies to invest wisely and prudently in the Indian market. I hope you enjoyed this video and learned something new about FIIs and smart money concepts. If you did, please give this video a thumbs up and share it with your friends who are interested in investing. Also, don't forget to subscribe to my channel for more videos like this. Thank you for watching and I'll see you in the next video.